Okay, derivatives. From the CFA Level 1 program curriculum, learning study session 18. Topic level learning outcomes. The candidate should be able to demonstrate a working knowledge of the analysis of derivatives, including forward, futures, options, and swaps. Derivatives, financial instruments whose price are derived from the value of something underlying asset. Some underlying asset, some becomes increasingly important for financial risk, exploiting investment opportunities, and creating synthetic asset class exposure. As in other security markets, arbitrage and market efficiency plays a critical role in establishing prices for these securities. Study session 18, derivatives. This study session builds on the conceptual framework for understanding the basic derivatives of derivative markets, essential features and valuation concepts for for commitments such as forwards, futures, and swaps, and contingent claims such as options are introduced. Reading assignments, we have reading 56 and reading 57. Derivative markets and instruments. The candidate should be able to define a derivative and distinguish between exchange traded and over-the-counter derivatives. Contrast forward commitments with contingent claims. Define forward contract, future contracts, options, swaps, and credit derivatives, and compare their basic characteristics. Describe purposes of controversies related to derivative markets. Explain arbitrage and the role it plays in determining price and promoting market efficiency. Introduction. Equity, fixed income, currency, and commodity markets are facilities for trading in basic assets of the economy. Equity and fixed income securities are claims on the assets of the company. Currencies are the monetary unit issued by the government or central banks. Commodities are natural resources such as oil or gold. These underlying assets are set to trade in cash markets or spot markets, and their price are sometimes referred to as cash price or spot price. Though we usually just refer to them as stock prices, bond prices, exchange rates, and commodity prices. These markets exist around the world and receive much attention in financial mainstream media. Hence, they are relatively familiar not only to financial experts but also to the general population. Somewhat less familiar are the markets for derivatives, which are financial instruments that derive their value from the performance of these basic assets. This reading is an overview of derivatives. Subsequent reading will explore many aspects of derivatives and their uses in depth. Among the questions that the first reading will address are as follows. What are the defining characteristics of derivatives? What purpose do derivatives serve for financial participants? What is the distinction between a forward commitment and a distingent claim? What are the forward and future contracts, and what ways are they alike, and what ways are they different? What are swaps? What are calls and put options, and how do they differ from forwards, futures, and swaps? What are credit derivatives, and what are the various types of credit derivatives? What are benefits of derivatives? What are some criticism of derivatives, and to what extent are those founded? What are arbitrage, and what role does it play in a well-functioning financial market? Derivatives definition and uses. The most common definition of derivatives read approximately as follows. A derivative is a financial instrument that derives its performance from the performance of an underlying asset. This definition, despite being so widely quoted, can nonetheless be a bit troublesome. For example, it can also be described mutual funds and exchange-traded funds, which would never be viewed as a derivative, even though they derive the value from the values of underlying securities they hold. Perhaps the distinction can be best characterized as derivatives in that they usually transform the performance of the underlying asset before paying out the derivatives transactions and contracts. In contrast with the exception of expense deductions, mutual funds and exchange-traded funds simply pass through the return of their underlying securities. This transformation of performance is typically understood or implicit in reference to derivatives, but rarely makes its way into the formal definition. In keeping with customary industry practices, the characteristic will be retained as an implied, albeit critical factor distinguishing derivatives from mutual funds. Derivatives are similar to insurance in that they both allow the transfer of risk from one party to another. As anyone knows, insurance is a financial contract that provides protection against loss. The party bearing the risk purchases the insurance policy, which transfers the risk to the party, the issuer, for a specified period of time. Derivatives are created from a legal contract and they involve two parties, the buyer and the seller, each of whom agrees to do something for the other. Either now or later, the buyer who purchases the derivative is referred to as a long of the holder because he holds or owns the derivative and holds a long position. The seller is referred to as the short because he has a short position. A derivative contract always defines the rights and obligations of each parties. These contracts are intended to be, and almost are, recognized by the legal system and as commercial contracts that each party expects to uphold and support in the legal system. Nonetheless, disputes sometimes arise, and lawyers, judges, and juries may be required to step in to resolve the matter. There are two general classes of derivatives. Some provides the ability to lock in a price at which one might buy or sell the underlying. But they force the two parties to transact in the futures at a previously agreed upon price. These instruments are called forward commitments. The various types of forward commitments are called forward contracts, future contracts, and swaps. Under the class of derivatives provides the rights but not the obligation to buy or sell the underlying at a predetermined price. Because the choice to buy or sell versus doing nothing depends on the particular random outcome, these derivatives are called contingent claims. The primary contingent claim is called the option. The practice of risk management has taken a prominent role in financial markets. Indeed, whenever companies announce large losses from trading, lending, or operations, stories abound about how poorly these companies manage risk. Such stories are great attention grabbers and a real boon for the media, but they often miss the point that risk management does not guarantee the large losses will not occur. Rather, risk management is the process by which an organization or individual defines the level of risk in which it wishes to take, measure the level of risk it is taking, and adjust the latter to equal the former. Risk management never offers a guarantee that large losses will not occur, and it does not eliminate the possibility of total failure. To do so would typically require the amount of risk taken to be small, and the organization would be effectively constrained by the pursuing its primary objectives. Risk taking is inherent in all forms of economic activities and life in general. The possibility of futures is never eliminated. Note that risk management is a dynamic and ongoing process, reflecting the fact that the risk assumed can be difficult to measure and is constantly changing. As noted, derivatives are tools, indeed the tools that make it easier to manage risk. Although one can trade stocks and bonds the underlying to adjust their level of risk, it is almost always more effective to trade derivatives. Risk management is addressed more directly elsewhere in the CFA curriculum, but the study of derivatives necessarily entails the concept of risk management. In the explanation of derivatives, the focus is usually on the instrument, and it is easy to forget the overriding objective of managing risk. Unfortunately, that would be like a carpenter obsessed with his hammer and nails, forgetting that he is building a piece of furniture. It is important to always try to keep an eye on the objective of managing risk. The structure of derivative markets, having an understanding of equity, fixed income, and currency market is extremely beneficial, indeed quite necessary in understanding derivatives. One could hardly consider the wisdom of using derivatives on a share of stock if one does not understand the equity market reasonably well. As you likely know, equities trade on organized exchanges as well as in over-the-counter markets. These exchange-traded equity markets, such as the Deutsche Börse, the Tokyo Stock Exchange, and the New York Stock Exchange, and the Formal organizational structures that bring buyers and sellers together through market makers or dealers to facilitate transactions. Exchanges have formal rules, structures that are required to comply with all securities laws. OTC security markets operate in much of the same manner, with similar rules, regulations, and organizational structures. At one time, the major difference between OTC and exchange markets is the securities will be later bought. Was that the latter bought buyers and sellers together in a physical location, whereas the former facilitates trading strictly in an electronic manner. Today, these distinctions are blurred because many organized securities exchanges have gone completely electronic. Moreover, OTC securities markets can be formally organized structures such as the NASDAQ, or can merely reflect the informational network of parties who buy and sell with each other, such as corporate and government bonds markets in the U.S. The derivative world can also comprises organized exchanges and OTC markets. Although the derivatives world is also moving toward less distinction between these markets, there's clear differences in the important understanding. Exchange traded derivative markets. Derivative instruments are created and traded either on the exchange or on the OTC market. Exchange traded derivatives are standardized, whereas OTC derivatives are customized. To standardize a derivative contract means that the terms and conditions are precisely specified by the exchange, and there is very limited ability to alter these terms. The subsidiarization of contract terms facilitates the creation of more liquid markets for derivatives. If a market participant knows that derivatives in the euro trades at 100,000 unit lot, and that they all expire only on certain days, the market functions more effectively than when it has only derivatives with many different unit sizes and expiration dates competing in the same market and the same time. This standardization makes it easier to provide liquidity through designated market makers. Derivative exchanges guarantees that derivatives can be bought and sold. The cornerstone of exchange-traded derivatives markets are the market makers or dealers of the speculators, both of whom typically are members on the exchange. The market maker stands ready to buy when price and a seller of a higher price. With standardization of terms and an active market makers are often able to buy and sell more almost simultaneously at different prices, locking in small short-term profits, a process commonly known as escaping. In some cases, however, they are unable to do so, thereby forcing them to either hold exposed positions or find other parties with whom they can trade, and thus lay off the risk. This is when speculators come in. Although speculators are market participants who are willing to take a risk, it is important to understand that being a speculator does not mean the reckless assumption of risk. Although speculators will take large losses at times, good speculators manage these risks by watching their exposures, absorbing market information, observing the flow of orders in a manner that they are able to survive the profit. Standardization also facilitates the creation of a clearing and a settlement operation. Clearing refers to the process by which the exchange verifies the execution of a transaction. It records the participants' identities. Settlement refers to the related process in which the exchange transfers money from one participant to the other, or from the participants to the exchange, or vice versa. This flow of money is a critical element of derivatives trading. Clearly, it would be no confidence in the market in which money is not efficiently collected and distributed. The clearing and settlement process of derivatives transactions also provide a credit guarantee. If two parties engage in a derivative contract on an exchange, one party will ultimately make money and the other will lose money. Derivative exchanges use their clearing houses to provide a guarantee to a winning party. If the loser does not pay, the clearing house will pay the winning party. The clearing house is able to provide the credit guarantee by requiring cash deposits, usually called margin bonds or performance bonds, from the participants up to the contract. Each markets are said to have transparency, which means the full information on the transactions is disclosed to exchanges and regulatory bodies. All transactions are centrally reported within the exchange and their clearinghouses, with specific laws requiring that these markets to be overseen by the national regulators. Over the counter derivative markets, the OTC derivative markets comprise an informational network of market participants that are willing to create and trade virtually any type of derivative that can legally exist. The backbone of these markets is the set of dealers, which are typically banks. Most of these banks are members of a group called International Swaps and Derivatives Association, or ISDA, a worldwide organization of financial institutions that engage in derivatives transactions primarily as dealers. As such, these markets are sometimes called dealer markets. Acting as principals, these dealer informally agrees to buy and sell various derivatives. It is informal because the dealers are not obligated to do so. Their participation is based on the desire to profit, which they do by purchasing at one price and selling at a higher price. Although it might seem that the dealer who can buy low and sell high could make money easily, the process in practice is not that simple, because OTC instruments are not standardized. A dealer cannot expect to buy a derivative at one price and simultaneously sell a different party who happens to want to buy the same derivative at the price higher than the original. Types of derivatives. As previously stated, derivatives fall into two general classifications: forward commitments and contingent claims. The factor that distinguishes forward commitments and contingent claims is that the former obligates the parties to engage in transactions at the future date on terms agreed upon in advance, whereas the latter provides one party the right but not the obligation to engage in future transactions on terms agreed in advance. Forward commitments are contracts entered into at one point in time that requires both parties to engage in a transaction at a later point in time. On terms agreed upon at the start, the parties establish the identity of the quantity of the underlying. This manner in which the contract will be executed or settled when it expires, and a fixed price at which the underlying will be exchanged. This fixed price is called the forward price. As a hypothetical example of a forward contract, suppose that today Marcus and Joannis enters an agreement that Marcus will sell his BMW to Joannis for a price of 30,000 euros. The transaction will take place on a specified date, say 180 days from today. At the time, Marcus will deliver the vehicle to Joannis' house, and Joannis will give Marcus' bank certificate check of 30,000 euros. There would be no recourse. So if the vehicle has a problem later, Joannis cannot go back to Marcus for compensation. It should be clear that Marcus and Joannis must do their due diligence and carefully consider the reliability of each other. The car could have serious quality issues, and Joannis could have financial problems and unable to pay the 30,000 euros. Obviously, the transaction is essentially unregulated. Either party can renege on his obligation, in response to which other party could go to court, provided a formal contract exists and is carefully written. Note finally that one of the two parties is likely to end up gaining and the other losing, depending on the secondary market price of the type of vehicle in the expiration of the contract. Forward contracts. Forward contract is an over-the-counter derivative contract in which two parties agrees that one party, the buyer, will purchase the underlying asset from the other party, the seller, at a later date at a fixed price they agree on when the contract is signed. The long hope of the price of the underlying asset will rise above the price forward, whereas the short hopes that the price of the underlying will fall below the forward price, except the extremely rare events in that the underlying price of T equals the forward price. There will ultimately be a winner or a loser. An important element of forward contracts is that no money changes hands between parties when a contract is initiated. Unlike the purchase and sell of an asset, There is no value exchanged at the start. The buyer does not pay the seller some money and obtain something. In fact, forward contracts have zero value at the start. They're neither assets nor liabilities, as you will learn in later readings. Their values will deviate from zero later as prices move. Forward contracts will almost always have non-zero values at expiration. Finally, forward contracts need not specifically settle by delivery of an underlying asset. They can settle by an exchange of cash. These contracts, called non-derivable forwards or NDFs, cash settled forwards and contracts for differences have the same economic effect as do their delivery-based counterparts. For example, for a physical delivery contract, so this is an example. Futures contracts are special versions of forward contracts um, that have been standardized and that trade on futures exchanges by standardizing these contracts and creating an organized market with rules, regulations, and a central clearing. Formally, a future contract is defined as follows. A future contract is a standardized derivative contract created and traded on a futures exchange in which two parties agree that one party, the buyer, will purchase the underlying asset for the other party, the seller, at a later date at a price agreed by the two parties when the contract is initiated, and in which there is a daily setting of gains and losses on a credit guaranteed by the future exchange through the clearinghouse. Okay, so that's just explanation of the quote. Contingent. Let me read this paragraph. This material completes our introduction to forward commitments. All forward commitments are firm contracts. The parties are required to fulfill the obligation they agree to. The benefit of this rigidity is that neither party pays anything to the other when the contract is initiated. If other party needs to some flexibility, however, it can get it by agreeing to pay the other party some money when the contract is initiated. When the contract expires, the party who pays at the start has some flexibility in deciding whether to buy the underlying asset at a fixed price. Thus, the party did not actually agree to do anything. It has a choice. This is the nature of contingent claims. A contingent claim is a derivative in which the outcome of payoffs is dependent on the outcome of payoffs of an underlying asset. Although this characteristic is also associated with forward commitments, a contingent claim has come to be associated with the right, but not the obligation to make final payment contingent on the performance of the underlying, given that the holder of the contingent claim has a choice in the term of contingent claims has become synonymous with the term option. The holder has a choice of whether or not to exercise the option. The choice creates a payoff that transforms the underlying payoff in a more pronounced manner that is a forward future swap. These instruments provide linear payoffs. As the underlying goes up or down, the derivative gains, losses, features up or downs, the underlying goes. Options, we might say that an option as a contingent claim grants the right but not the obligation to buy the asset at a later date and at the price agreed on when the option is initiated. But there are also many variations of options that we cannot settle on this statement as a good formal definition. For one thing, options can also grant the right to sell instead of the right to buy. Moreover, they can grant the right to buy or sell earlier than an expiration. So let us see whether we can combine these points into an all-encompassing definition of an option. An option is a derivative contract in which one party, the buyer, pays a sum of money to the other party, the seller or writer, and receives the right to either buy or sell an underlying asset at a fixed price, either on a specific expiration date or at any time prior to the expiration date. Credit derivatives. Credit risk is surely one of the oldest risks known to man. Human beings have been lending things to each other for thousands of years, and even the most primitive human beings have must have recognized the risk of lending some of their possessions to other comrades. That sounds awfully communist. Lending things, owning stuff, comrades, communism, Karl Marx. Okay. Until the last 20 years or so, however, the management of credit risk was restricted to simply doing the best analysis possible before making a loan, monitoring the financial conditions of the borrower, doing the loan, limiting the exposure of a given party, and requiring collateral. Some modest forms of insurance against credit risk have existed for numbers of years. Credit derivatives. For example, a credit derivative is a class of derivative contract between two parties, a credit protection buyer and a credit protection seller, in which the latter provides protection and the former protects former against a specific credit loss. Okay. A credit default swap is a derivative contract between two parties, a credit protection buyer and a credit protection seller, in which the buyer makes a series of cash payments to the seller and receives a promise of compensation for a credit loss resulting from a default of a third party. Okay. When bonds or loans are assembled in ABSs, asset-backed securities, they are typically called collateralized bond obligations, or CBOs, or collateralized loan obligations, CLOs. These instruments, known collectively as collateralized debt obligations, do not traditionally have much repayment risk, but they do have credit risk, and oftentimes a great deal of it. The CDO structure allocates the risk to tranches that are called senior, mezzanine, mezzanine, or junior tranches. When default occurs, the junior tranches bear the risk first, followed by mezzanine tranches, and then senior tranches. The expected returns of the tranches vary according to the perceived credit risk. When the senior tranches having the highest credit quality and the junior is the lowest, thus the senior tranches have the lowest expected return and the junior tranches have the highest. An asset-backed security is a derived contract in which a portfolio of debt instruments is assembled and claims are issued on the portfolio in the form of tranches, which have different priorities of claims on the payment made by the debt securities, such that payments or credit losses are allocated to the most junior tranches first and the most senior tranche last. Hybrids. The instruments just covered encompasses all the fundamental instruments that exist in the derivative world, yet the derivative world is truly much larger than implied by what has been covered here. We have not yet covered, and we'll touch upon lightly on the many hybrid instruments and combined derivatives, fixed income securities, currencies, equities, and commodities. For example, options can be combined with bonds to form either callable bonds or convertible bonds. Swaps can be combined with options or form swap payments that have higher upper or lower limits. Options can be combined with features to obtain options on features. Options can be created with swaps as the underlying to form a swap option. Some of these instruments we'll cover later. For now, okay. Derivative underlyings. By discussing the purpose of benefits of derivatives, we need to clarify some points that have been applied so far. We have alluded that certain underlying assets. This section will briefly discuss the underlying more directly. Equities are one of the most popular categories of underlying on which derivatives are created. There are two types of equities on which derivatives exist: individual stocks and stock indexes. Derivatives on stocks are primarily options, forwards, futures, swaps, and individual stocks are not widely used. Index derivatives is in the form of options, forwards, futures, and swaps are very popular. Index swaps, more often called equity swaps, are quite popular and permits investors to pay the return on one stock index and receive the return on another index or a fixed rate. In addition, options are on stock exchange on stocks are frequently used by companies as compensation and incentives for the executives and employees. These options are granted and provide incentives to work towards driving the stock price up and can result in the companies paying lower cash compensation. Fixed income instruments and interest rates, options, forwards, futures, and swap bonds are widely used. The problem with creating derivatives on bonds, however, is that they are almost always more issues of bonds. A single issuer, whether the government or a private borrower, often has more than one bond issued outstanding. For future contracts, when a standardization requirement, the problem is particularly challenging. What does it mean to say that a future contract on a German bond, a U.S. Bund, a U.S. Treasury note, and U.K. gilt? The most common solution is the problem to allow multiple issues to be delivered and a single future contract. The future adds some interesting twists to the pricing and trading strategies of these instruments. Currencies, commodities, credit, and others may also be used for the underlying of the bond. Underlying of the derivatives. The purpose and benefit of derivatives. Economic historians know that derivative markets have existed since at least the Middle Ages. It's unclear whether derivatives originated in the Asian rice markets or possibly medieval trade fairs in Europe. Well, that's a big stretch. Possibly in China. China had a very advanced monetary system when Europe was still in the Dark Ages. We do know that the origins of modern future markets are the creation of the Chicago Board of Trade in 1848. To understand why derivatives market exists, it is useful to take a brief look at the Chicago Board of Trade was formed. So this is just the history of the Chicago Board of Trade. The traders in Chicago began to trade these contracts, speculating on movements of grain prices. Soon it became apparent that an important and fascinating market has developed. Widespread hedging and speculative interest resulted in substantial market growth. As about 80 years later, the clearinghouse and the performance guarantees were added, thus completing the evolution of the two contracts into today's modern future contracts. Many commodities and all financial assets that underlie derivative contracts are not seasonally produced. Hence, this initial motivation for future markets is only a minor advantage of derivative markets today. But there are many reasons why derivative markets serve an important and useful purpose in contemporary finance: risk allocation, transfer and management, information discovery, operational advantages, market efficiency. So these are the reasons. Criticism and misuse of derivatives. A history of financial markets is filled with extreme ups and downs, which are often called bubbles and crashes. Bubbles occurs when price rise for a long time and appears to exceed fundamental value. Crashes occurs when prices fall rapidly, although bubbles, if they truly exist, are troublesome. Crashes are even more so because nearly everyone loses substantial wealth in a crash, unless you're a shorter, which in case, sure. A crash is then typically followed by a government study commissioned to find the causes of the crash. In the last 30 years, almost all such studies have implicitly implicated derivatives as having some role in causing the crash. Of course, because derivatives are widely used to involve a high degree of leverage, it is all given that that they would be seen in a crash. It is unclear whether derivatives and the real corporate or just a proverbial smoking gun used by someone to do something wrong. The two principal agreements or arguments against derivatives are that they are such speculative derivatives devices and they effectively permit legalized gambling, and that they destabilize the financial system, destabilize the financial system. Let us look at some of the points more closely: speculatism and gambling. So yeah, destabilization and systematic risk. Elementary principles of derivative pricing. Okay. Pricing evaluation, a fundamental element of CFA program, the study of fixed income and equity securities, as well as the application portfolio management. Determining what a derivative is worth is similar to determining what an asset is worth, as you learn in the fixed income and equity readings. Value is the present value of future cash flows. When discounting, with discounting done. Derivative valuation applies to some principles, but in somewhat different ways. Um, Derivatives usually take the value from underlying constructing a hypothetical combination of derivatives that underlying the ultimate risk. This combination is typically called a hedge portfolio. With the risk eliminated, it follows the hedge portfolio should earn the risk-free rate. A derivative's value is the price of the derivative that forces the hedge portfolio to earn the risk-free rate. The principle of derivative valuation relies completely on the ability of an investor to hold or store the underlying asset. Let us take a look at what this means. There's storage, and then there is arbitrage. Ooh, arbitrage is the biggest problem in finance, for my opinion. Okay, summary. This first reading on derivatives introduces you to the basic characteristics of derivatives, including the following points. A derivative is a derivative is a financial instrument that derives its performance from the performance of the underlying asset. The underlying asset called the underlying is trades in the cash or spot market, and its price is called the cash or spot price. Derivatives consist of two general classes: forward commitments and contingent claims. Derivatives can be created as standardized instruments on derivative exchanges or as customized instruments in the over-the-counter market. Exchange-traded derivatives are standardized, highly regulated, and transparent transactions that are guaranteed against default through the clearing house or the derivative exchange. One of the counter derivative are customized, fixable, and more private and loss regulated than exchange traded derivatives, but are subject to greater risk of default. A forward contract is an over-the-counter derivative, a contract in which two parties agree that one party, the buyer, will purchase the underlying asset from the other party, the seller, at the later date, and at a fixed price they agree upon. One contract is assigned. A future contract is similar to a forward contract, but is a standardized derivative contract created at the trade and traded on a futures exchange. In the contract, two parties agree on that one party, the buyer, will purchase the underlying asset from the other party, the seller, at a later date, and the price agreed on by the two parties when the contract is initiated. In addition, there is a daily setting of gains and losses and a credit guarantee by the futures exchange through its clearinghouse. A swap is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flows, whereby one party pays a variable a variable series that will be determined by an underlying asset or a rate that other parties either a variable series determined by a different underlying asset or rate or a fixed series. An option is a derivative. Let me ask Siri a question. Heads or tails? An option is a derivative contract in which one party, the buyer, pays a sum of money to the other party, the seller or writer, and receives the right to either buy or sell an underlying asset at a fixed price, either on a specific expiration date or at any time prior to the expiration date. A call is an option that provides the right to buy the underlying. A put is the option that provides the right to sell the underlying. Credit derivatives are a class of derivative contracts between the two parties, the credit protection buyer and the credit protection seller, in which the latter provides protection to the former against a specific credit loss. A credit default swap is the most widely used credit derivative. It is a derivative contract between two parties, a credit protection buyer and a credit protection seller, in which the buyer makes a series of payments to the seller and receives a promise of compensation for the credit loss resulting from the default of a third party. An asset-backed security is a derivative contract in which a portfolio of debt instruments is assembled and claimed issued on the portfolio in the form of tranches, which have different properties of claims on the payment made by the debt securities, such as the payment of credit losses, and allocated to the most junior tranches first and the most senior tranches last. Derivatives can be combined with other derivatives or underlying assets to form hybrids. Derivatives are issued on equities, fixed income securities, interest rates, currencies, commodities, credit, and a variety of such derivatives underlying weather, electricity, and disaster claims. Derivatives facilitates the transfer of risk, enable the creation of strategies and payoffs not otherwise possible. When spot assets provide for information about the spot market, offer lower transaction costs, reduces the amount of capital requirement, are easier than the underlying to go short, and improve the efficiency of the spot market. Derivatives are sometimes criticized from being legalized gambling and for leading destabilizations of speculation. Although these points can generally be refuted, derivatives are typically typically priced by forming a hedge involving the underlying asset, and a derivative such as the combination must pay the risk-free rate and do so only one derivative price. Derivative pricing relies heavily on the principle of storage, meaning the ability to hold or store the underlying asset. Storage can incur costs, but can also generate cash, such as dividends and interest. Arbitrage is the condition that two equivalent assets or derivatives are combinations of assets and derivatives sell for different prices, leading to an opportunity to buy at a low price and sell at a high price, thereby earning a risk-free profit without committing any capital. The combined action of arbitrage bring about the convergence of prices. Hence, the arbitrage leads to the law of one price. Transactions that produces equivalent results must sell for equivalent prices. And this is reading 56. Okay, I do hope my readings have been helpful. The notes are in Amazon, so go ahead there, and I hope to see you guys next time. Goodbye.